Federal Reserve Chair Jerome H. Powell stated that while policymakers anticipate reducing interest rates in 2024, the timing depends on data. Powell mentioned that he expects the central bank to start lowering borrowing costs in 2024, but emphasized the need for greater confidence in overcoming inflation before taking action. In remarks prepared for the House Financial Services Committee, Powell indicated that the current policy rate is likely at its peak for this tightening cycle, and suggested that dialing back policy restraint could be appropriate later this year, if the economy evolves as expected. Although the Fed's next meeting is in March, it's unlikely that interest rates will be lowered then. The market anticipates the possibility of the first rate cut in June, with expectations of 3 or 4 reductions by year-end. Powell cautioned against premature rate cuts, warning that reducing policy restraint too soon could reverse progress on inflation. On the other hand, waiting too long could weaken economic activity and employment. The Fed aims to strike a balance between cooling the economy without causing undue harm to employment. While inflation has decreased, it remains above the Fed's target of 2%. Despite inflation easing, the job market remains strong, with unemployment at 3.7%. Fed officials are optimistic that their policies are helping to bring the economy into balance, potentially leading to a normalization of price increases. Powell highlighted improvements in labor market conditions, indicating that supply and demand dynamics are gradually stabilizing.